It's time to take a closer look at those PMI numbers right now with Abdul Davids. He's head of research at Kagiso Asset Management, and he joins us live from our Cape Town studios at this stage. Thanks so much, Abdul, for joining us today. Well, we've got the PMI having increased, but staying below that 50 mark. We're at 47.6, 46.7 index points at this stage of the game. It's the second month that we've got this index below the 50 line and averaging 45.5 so far, sharply down from that average of 55.3 in the first half of this year. Safe to say that indications are for slower and a worse second half here?
I think so. Thank you very much. I think one of the issues that we look at is the leading indicator, and that has contracted significantly, and it goes back to numbers that we've last seen in mid-2009 when we came out of the global crisis. So I think clearly in terms of that number as a potential indicator of what the September and maybe even the October number is going to look like, it does look like we're in for tough times going ahead.
Of course then, so when you look at these numbers, and go through things, number by number, there are interesting bits. We've got the business activity index, which plunged by more than 19 points in July, having recovered by 10.7 points to 46.6 in August. But you've got to ask the question then, how much do you actually read into that, given the fact that we are coming off a low base?
Yes, I think the July base was extremely low, bearing in mind that the PMI came from about 53, just over 53 in June, and fell by about just over 10 points in July. Impacted significantly by the strike activity. Clearly that impacted for the first 2 weeks of July in particular. So we were always due for a rebound. I think the consensus number was fairly in line with the actual number that was reported. So clearly the strike impact that we saw in the first 2 weeks of July, some of that continued in the third week of July. So July was an extremely low base. So as I said, we were always due for a rebound. What was surprising was the extent of the rebound was actually quite muted by about 2.5 points, as you rightly said at the beginning. So clearly there are some underlying concerns and more structural issues that underlie our manufacturing sector, which continue to be the case despite the absence of significant strike activity in the month of August.
Of course, we've got to consider then how our growth is impacted by international markets, where that correlation is still standing front and center. So to what extent has this number reflected the downshift we've seen in GDP growth, not only in Europe, the US as well? And then, we had Ian Cruikshanks earlier on saying even out of China, that PMI number slightly above 50 still leaves things pretty finely balanced on that end too.
Yeah, that's a very good point. I think we are seeing the evidence of the global economy and the interlinked nature of economies across the world. Bearing in mind that South Africa, a lot of our trading activity happens with Europe and the US in particular. So the particularly weak PMI numbers that we're currently seeing coming out of Europe is obviously a bad indicator for us going forward. I think just drilling down to some of those PMI numbers that we are seeing, expected business conditions, new sales orders, all of them fairly weak across Europe. And another indicator that we are likely in for a bumpy ride in Europe. And unfortunately, as I said, given the fact that Europe is actually our largest trading partner, we are likely to see some of that impacting our local market. I think we are going against the grain a bit with the rebound that we have seen in the August number, given that we came out of a low base. But in the absence of the strike activity, I think the number would have been probably down on July again. So given that fact, I think the September number is likely to be under pressure. At best, we should hope for a stable number, but at worst, it could be down given the August numbers as well.
And to highlight is that, it's supply constraints that are playing very little role here. It's actual demand that is a problem, especially being highlighted by that backlog of sales orders numbers, which is declining steadily as well.
Yes, I think that's a very good indicator of capacity utilization in the sector. Clearly, with the backlog of orders being eliminated, it's an indicator of weaker current demand, but also the buildup of inventories that we are seeing. We are seeing a buildup of inventories, and that's pointing to very low activity levels at the moment. So the new sales orders numbers that have come down, the expected business conditions that have been weaker, points to the fact that purchasing managers in South Africa in particular are fairly bearish in terms of their outlook. And that's filtering through to the current activity that they are seeing at the moment at the factory gate. And that clearly, as I said, is an indicator of September potential capacity utilization levels being fairly weak, if not stable from the August level as well.
And that in turn then having an impact on prices as well, because despite inflation ticking higher, we've got prices staying pretty steady at 75.2 at this stage of the game, after having fallen back quite a bit in the first half of this year.
That's right. It is also indicator of is the fact that there could be potentially some contraction in margins for the manufacturing sector. We know that the rand has weakened. We are by and large importing more than we're exporting at the moment. So clearly imported prices have been going up over the last 2 months or so. But the disjoint that we're seeing between the PMI price index and the PPI index, for example, is maybe an indicator of manufacturers' contraction in their gross margins that we are seeing. Another very weak indicator of current weak demand as well that we are seeing currently.
Just looking at a final line on that index, it's pertaining to employment, seeing a rise to 43.1 there. To what extent, though, again, we've got to ask that question, do you actually read any bit into this, given the fact that we are coming off a low base and we're still at a level that's consistent with a very weak factory sector job market?
That's right. And I think with the exception of the July number, which was clearly impacted again by what happened in July with the strike activity that I mentioned previously, we are seeing that number going back to levels that we've last seen in mid-2009, for example. Again, very symptomatic of the structural problems facing our manufacturing sector. We again, after the strike activity has been concluded, we are looking at multiple of CPI sort of price wage increases that we are seeing coming through for next year. So again, putting pressure on the employment situation. Clearly, there is a trade-off between what wage settlements are going to be and the actual employment levels. So given the fact that we are now a much higher base in terms of the wage numbers, between 8 and 10%, given the various underlying sectors, I think what we are likely to see is not a big recovery in the employment sector numbers, and at best probably a stabilization at current levels, unfortunately.
Abdul, let's leave it there. Thanks so much for your time this afternoon. Of course, Abdul Davids is Head of Research over at Kagiso Asset Management.